This is the Commercial Real Estate or the Investment Property Analyzer Calculator. This particular calculator has been built in Excel and will continue, as with the other calculators, to develop it over time. When you open it, it will open in Excel. What I'm going to do is go through the default case that's in here now for a client named Mr. Branson, and then you'll be able to then, once you download the Excel spreadsheet, save it to your computer and use it for other illustrations. Now, Mr. Branson is interested in buying a new office building. He's trying to decide if that's a good investment. What's his return going to look like over time? What's his cash flow going to look like over time? So you'll notice only the fields that can be edited here are in this sort of a light beige or light yellow. It denotes a field requiring your input or assumptions. So what you can do with this, again, you can print it, okay, and then it could be filled out by a client, or they could call you, or they could sit right in your office and you could enter the information in and you could send this back to them as a nice 3 or 4 page report. He's purchasing a property of $385,000. That's the purchase price or current value. The property loan amount he anticipates borrowing is $320,000. The current value is $385,000. He believes that he's paying what he believes to be the value of the property. You'll notice that numbers start calculating as you go through the process. So we now know that there's a down payment of $65,000 that's needed. The land allocation is about 10%. What that means is land is not depreciated. So we want to have an estimate of what percentage of the value of the property is from land versus from the building itself, which is depreciated. So that would mean we believe the land itself is worth around $38,500. Usually the appraisal will have on it the portion of the value that's attributed to land and the portion that's attributed to the building. So you can change this number later if you find out that in actuality it's 12%. Again, you can do your initial analysis and then come back and change that to 12% later. I'll leave it at 10% for now. Down payment from 1031 exchange. We know of no other calculator that we found that will actually do this calculation, and that is you actually can decide if the money for the down payment, the $65,000, is coming from a 1031 exchange. If you knew you had $100,000 coming in from a 1031 exchange, which is outside the scope of this conversation if you're not familiar with that, but it means that you're doing a tax-deferred exchange for a property, then I could come up here and say my purchase price is $385,000, but I'm going to borrow $285,000 because I have $100,000 coming from my 1031. And I would check yes here, because what that does is that means that all of the down payment money for the sale of this property is going to come from that exchange. And you'll notice down here the money I need at closing, my out-of-pocket investment, is dropped dramatically, because once I say that money's coming from another property, I no longer need to bring that to the closing table as out-of-pocket initial investment. If I change that to no, suddenly I'm coming to the closing table with $103,000. But I'm going to go back to our default here, $320,000, which means I'll need the $65,000 as a down payment, and that down payment is not coming from a 1031 exchange, meaning it's going to come from me. If there are any improvements, maybe I know that I'm going to have to put about $8,000 into this property for some immediate improvements, a new sign in the front and things like that, I would put that number here. So we assume that the improvement value is going to increase by that amount, and I can also see that I have to bring the additional $8,000 to closing, so it's totaling up now what I need to bring to the closing table. Now the rent that's scheduled for this property, it's a single unit. Let's just say it's 2. All right, I can change that. And the rent per unit is $3,300. So now I can see that I have $6,600 in total rent coming in. All right. If it was 4 and I was getting $2,000 per unit, I can change that. Or if it's multiple units but I have an exact number that I'm working with, I can just put in 1 unit and say that I know it's going to be $3,400 per month is what I expect from the entire building. And this is showing me my total gross for the year. It'll also, you'll show here, I have a first loan amount of $320,000 at 7%. That's my interest rate. If I can get this for 6.89, that's where I would change the interest rate. I'm going to assume that I can get a 7% interest rate on this building, and I'm assuming I can do a mortgage term of 30 years. If that's different, I can change it to the standard 25 or 20, whatever the case may be. I'm just going to use 30 for this example. And also, depending on the specific situation with the bank or the lender, maybe I'm going to go with an interest-only loan. Maybe I'm looking at borrowing off my margin account to buy this building, and I'm just going to pay interest. If that's the case, I might use interest only for my calculation. But again, if I use interest only and click this one button, yes, everything throughout the remainder of the calculation will be calculated for interest only versus amortizing. So what do we know so far? We've put in the purchase price, how much we want to borrow. We've put in any improvements. We've put in our expected gross rent for the building. Tell you what, let's bump that to $3,500 here. We expect to borrow at 7% over the 30-year term. If we find out later the bank will only lend on a 25-year term, one button and I've recalculated all my analysis, as you'll see below. But we'll keep that at 30. We'll assume that it's amortizing, so it's not interest only. And I'm able to scroll down here and see first that I have now my down payment plus my closing cost estimate. And I can change this if I find it's going to be $4,500. I just change that here. Improvements, and my out-of-pocket initial investment is $77,500. So now I know what I'm coming to the closing table with in this estimate. I can also see what I expect my mortgage payment to be each month, and an estimate of what kind of cash flow it's going to drain me just for the debt on my first and my second mortgages. So that's what we have so far. Now the next big area is annual operating expenses. We have some defaults in here you can use if you're not sure about, but property taxes. I believe property taxes for me are going to be closer to 1.5% on this particular property. No, that's way too high. Let's just use 1.1. Okay? I believe that the insurance is going to be around 0.75% of the overall expense ratio for this property. If you knew it was going to be exactly, $2,500, okay, you could just go in here and play with this to kind of get it as close as you can. We're using percentages because they tend to work out better and they're easier. Once you know the percentages in your market, you'll find that the property tax and the insurance, those costs stay pretty much the same. Maintenance, I believe I'm going to use 2% a year for my maintenance costs. That's money that I'm going to spend that will not improve the property value, but that will basically allow it to continue to operate. I have management here of 0. If I was paying a manager 4% to manage that property, I'd put it in right here. But we're assuming that that management is 0. Okay? And my maintenance is going to be around 2. And then I have utilities. I'm assuming around $200 a month for utilities, homeowner association fees. Now let's say that you know that you're passing the utilities through to this particular person, or you know that this is something that this is a building you're going to buy and lease out, and they're going to pay the utilities, then I might put that at 0. So again, you would play with these assumptions based on the situation that you have going on. I believe that I'm going to run about an 8% vacancy. Okay, that's approximately a month, meaning you'll have at least 1 month a year where someone's moving out and you're transitioning. And again, each of these numbers are calculated for you, and this is your operating expense estimates here. And you can see we're estimating total property expenses at around $17,798 for the year. Now we get into the remaining financial numbers, and after this point, everything else is calculated for you. We have the client's marginal tax bracket, state and federal, at 30%. We have the long-term capital gain rate, state and federal, 20%. We have the client's estimated holding period of 10 years. They believe that they'll buy this building and hold it for about 10 years. The estimated property appreciation rate on the building, they expect that to be closer to, let's say, 4%. And again, these numbers come from your interview with the client or from their information, or for your personal situation, you would use this to determine whether this is a good decision for you to buy an investment property, a vacation rental property, or a $5 million office building. It can be used for all of these different scenarios, as we have personally used this and had many, many people using this particular tool. Estimated annual rent increase. I believe I'll increase the rent 3% annually. Each year I will boost the rent 3% to adjust for inflation. But I believe my operating cost increase will be a little bit higher than that. I believe it'll be at 3.5% over the same period of time. But if I thought my operating expenses will go up at the same rate that my rent will go up, I can use 3 and 3. They're two different numbers because this is going to be the number that's inflated at 3% for property expenses, and the rent number is going to be inflated for this particular number. Now, this is another very powerful aspect of this tool, future property sale. Will this be sold by a realtor? If I go down to 0%, no, that assumes that the owner would sell it themselves. Maybe they're a realtor, maybe they're comfortable selling their own property, but that has an impact on future net worth. If you believe that you'll sell it in the future using a realtor and that you'll pay about 6% to do that, you would put that 6% in because that's going to affect your future net worth. Just as closing costs and all the numbers here affect what we're really looking for, which is impact to net worth and return over time. Now, would this property be exchanged in the future? Meaning I'll pay 6% to sell it, but will I pay taxes on it in the future? Or will I exchange this into a new property and defer the taxes on the future? Now, we've set up here that this is not a 1031 coming in, meaning that I would not be coming up with cash from a sale of another property. This is the first property I've bought like this, so I'm going to come out of pocket this money here. But I could say that I think I'm going to sell it and exchange into a new property in the future. And so I'm going to leave that at yes. I believe my after-tax return rate or my opportunity cost to invest elsewhere is about 8%. Meaning if I didn't do this deal, if I didn't buy this investment property, I could continue to invest the $77,500 somewhere else and earn 8% after tax on it. And if I said that's high, I think it'd be closer to 7% after tax. Again, I could modify that number here. So that's important. We're looking at an apples to apples comparison. Do this, you've lost use and control of that down payment, but you have some potential upside, and that potential upside we're going to look at here now. I can see right away my mortgage balance is going to be dropping to around $274,600 at the end of my holding period. If I said I was going to only change this holding, I was going to only look at holding this for 8 years. Again, everything on this sheet is completely recalculating for you dynamically so you can do some assumption modeling that's very powerful for your client. Everything below this is going to be calculated for you. So now we see this is the gross scheduled income for the property. This is what we expect the property income to be in the first year. Why first year? Because we assume that we're going to inflate that income by 3% annually, so second year, third year will be slightly higher. Less the operating expenses. Again, first year operating expenses, because we assume that those would go up 3% a year. Here's my net operating income. So right out of the gate, I've got this income minus these expenses. That leaves net operating income to service the debt. I know my debt is going to be around $22,400. So before taxes, I have about an $1,803 per year profit that I would expect this property to generate based on this scenario. Now, if I look at cash flow before taxes and include principal, because principal is my money that I'm transferring to pay down this note, I actually have an after-tax cash flow, including principal, loss of $1,345. So I didn't lose wealth because I transferred that principal to pay down the note, but it's going to feel like I lost $1,345 in the first year. Now, why do I say in the first year? Because over time, that's going to change if you're inflating the rent. But I want to know what's going to happen in the first year. Now, if I look at cash flow after tax, I see that, again, I've got this net operating income of $24,203, same number here. But because of real estate, I have annual interest payments and I have depreciation. I get to depreciate that property over time. So my annual depreciation is about $12,000 a year, which is a taxable income or loss, in this case a loss of $10,830. I didn't actually pay $10,830 out of my pocket, but from a tax standpoint, I get to treat it like I did. And I'm in a 30% tax bracket. So what this does is this actually creates a $3,249 paper loss for me. So while it felt like I lost $1,345, because I really did, from a tax standpoint, I'm then getting $3,249 back as a credit. So it's going to actually, after tax, feel like I made $1,904 per year in this first year of this property, or $158.65 a month. So we're trying to take all the real numbers. If you've never invested in property before, and you know there's cash flow benefits and tax benefits, this is breaking it out for you here and showing you the actual numbers, what it actually feels like before taxes and what it actually acts like after taxes. So I could say, hey, in investing this particular amount of money, I'm going to feel like I'm making $1,000. Well, I'm going to feel like I'm actually, so it's going to feel like I'm earning $158.65 a month. Okay, so very powerful, because some people will look at cash flow, but they don't really understand the net cash flow impact, the real cash flow impact. In other words, I'm actually from a wealth standpoint earning $1,803 per year before taxes, but I'm transferring some of that wealth into the property as principal. Okay, so from a true, including principal, it's going to feel like $1,345 per year is going out of my account, even though that's being added into or paying down this principal balance. Now let's look at the future value illustration, because this is key. This is where the rubber hits the road when we look out and project out over the holding period. At purchase, this property was worth $393. After we made some improvements, we assume it's going to grow at 4% annually for 10 years. So we're estimating that at the end of the holding period, the property is going to be worth around $581,000. Now, I have a sales cost. That came from where? That 6% realtor fee that I'm paying. Now, I paid $393 and closing costs and improvements. All right, so that is part of what makes up my basis. That's the money that I have put into this property. And when I sell it, there's a recapture of that depreciation benefit over that time period. So what's happening is it's saying you paid $393 plus $4,500 plus $8,000 to buy this property, but you got $126,000 in benefits over the 10 years from depreciation. That reduces my basis, because that was real money I got the benefit of over that 10-year period. So my actual basis is $279. So if I look at my taxable gain on sale, okay, which is the difference between the future value here, what I sell it for, and my adjusted basis, I actually have a gain on sale of $267,653. That's what I'd have to pay taxes on at a rate of 20%. Now, I also have a depreciation recapture of 25% that's all being factored into this. Now, it says tax due from sale, 0. Wait a minute, why 0? Because remember, I said I was going to do a 1031 exchange when I sold this. So what this is doing is it's calculating the actual tax and all of the deferral, but it's saying you're not going to pay anything at this closing because you're deferring it. Now, what's really cool about this is I can come up here and say no, click one box, and look back at the same number here and look at the tax due from sale. If I don't defer this in a 1031, I'm going to come out of pocket about $60,000 at the closing of this transaction. So again, very powerful tool. I'll just leave it off for now and assume you're paying the taxes. So this gives it all to you right here. The estimated sales price is $581,736. I'm paying $34,000 in realtor commissions. I got to pay off my mortgage balance at that time of $274,600. I've got to pay all the taxes due from the sale, and I would estimate that my after-tax proceeds from this sale is going to be around $212,000. So that lets me know what my after-tax net back to me would be. Now, that could be my future wealth, but remember, I had that cash flow each month coming into me. Remember, over time, we were receiving a cash flow that starts off at $158.65 a month, okay, and then grows over time because we were, in fact, inflating that rent. So the net cash increase or decrease for my holding period was an additional $52,769 that was in my pocket, because we're recapturing all of the depreciation and stuff here. So that means that the future holding period wealth for me is 265,154. So again, very simple but very powerful in that everything is being taken into consideration here. And I can see that at the end of 10 years, I would expect to have my wealth increased by 265,154 in this example. Now here's where the rubber hits the road. I can look at this and look at this return and see if it's acceptable. My cash flow before taxes started out at $13.45 a year. But if I looked at my cash flow after taxes, it was actually feeling like $19.03 a year with the tax depreciation and stuff. My future wealth was $265,154. Okay, this is that number after all my expenses, and this was my $265,154. Now I made an initial investment of $77,500. That was my money. So if I look at my initial investment of $77,500 and I look at my net in-pocket return at the end of 10 years, that's a growth rate of 13.09%. Now if I look at that on a tax-adjusted basis, I actually see that it's a little bit higher, closer to 13.87%, because of the net effect over time value of money of the tax returns. It's closer to 14%. This is very powerful. Again, if I look at the exchange, if I said, yes, I'm going to defer this exchange, meaning in the future my taxes will be zero, then the actual return over the period here is 15.41. So it increases my effective return because I'm not going to pay taxes on that money, meaning when I buy a new property, I'll be able to defer the full $325.01, which is like being able to earn a 15.41% return. But I'll still pay those taxes in the future. That's why we have the tax-adjusted return here, which adjusts for the effective return if you had to pay those returns today. I can see that deferring it will increase the tax-adjusted return from 13.87 to closer to 15.41. Now you have all of the AM tables below. If you print this, it's just going to print these upper pages, but I can actually see here the amortization table on my loans. I can also see the adjusted rent, because again, we looked at this and said, hey, we got to adjust this rent over time. So if you wanted to look at my rent charge going up each month, I can see that, remember, $13.45 was my yearly pre-tax cash flow. First year was negative, but each year that's going up. So this is where I'm actually seeing, hey, my positive cash flow over this period of time, and we go out the full term of the loan, it's here. But if I was going to hold this out about 10 years, I'd probably be looking at $14,000 to $16,000 a year positive cash flow at the end of that time period. So again, very, very powerful tool that you can use to bring some clarity to your clients when they think about whether or not they should buy an investment property, a vacation property. They could do this for a second home. They're going to buy a beach house in the same scenario, and they expect that they'll be able to rent it during the summer, okay? But if they were only going to rent it for 3 months at $1,000 a week, that's $12,000. That's like getting rent of $1,000 per month, or $12,000 for the year. See how you could use this for a second home? I could then go down and say, you know, net here, okay, you've got about a 15% loss on your money over time. So it's not really the type of investment, but you can still see all the numbers, the flow through, the future value, and things like that, and see the financial impact of that. So a lot of different ways you can use it. You're thinking about buying your own office building, clients looking at building or buying some investment properties. And again, with the different assumptions, if they could get $360,000 financing, we know the appreciation is going to be the same. So we'll go back to our $3,500 a month. If they could buy this building with only $25,000 down, all right, we see some greater negative cash flows initially, but we can look at the impact of the return. 21% return, because they have a much smaller amount of money controlling that particular property. So again, lots of different ways you can use this. Hope this helps. Have a great day.